Good afternoon, everyone. On behalf of Solar Quarter and First View Group, I'm Ella, and it's my absolute pleasure to welcome you to today's webinar on selling solar assets in India, a guide to successful solar asset sales in India. India's solar industry is evolving rapidly, moving beyond greenfield development to a new phase, where the secondary market for solar assets is emerging as a major catalyst for growth. As operational assets shift hands, we're witnessing a dynamic rise in M&A activity, signaling the maturity of the sector and new investment opportunities. This webinar aims to unpack the key elements that influence the success of solar asset transactions in India, from regulatory compliance and PPA obligations to financial structuring and the vital role of intermediaries. Whether you're a developer planning an exit, an institutional investor seeking stable long term returns, or a professional navigating this evolving landscape, this session is designed to bring you clarity, insights, and actionable takeaways. So let's get started. Before we begin with our panel discussion, I just would like to screen a poll question here just to get to know our audience a bit better. So the poll questions will stay open till the end of our webinar, and I request our audience to please submit their votes. You have time till the end of the webinar, and I won't hold up more and proceed with the panel discussion now. Before we begin, I would just like to also mention a quick reminder. We'll be hosting a live Q&A session at the end, so please continue to share your questions in the Q&A box throughout the session. So, without further ado, today's discussion is titled Selling Solar Assets in India Unlocking the Secondary Market Potential. We're honored to be joined by an exceptional panel of industry leaders. We have with us Mr. Kareem Megherbi, Founding Executive Director, Orison Invest, Mr. Anune Shahi, SVP Corporate Finance from Renew, Mr. Kapil Kumar, Senior VP Asset Management from Blue Pine Energy, Mr. Atul Pachori, Head of Asset Management from Sirentica Renewables, Ms. Kritika Baralia, VP Azure Power, Ms. Swati Pisharodi, Partner Trilegal, and expertly moderating the discussion is Mr. Abhijit Kumar, Manager, Climate and Renewable Energy Finance at PwC. Welcome to all our esteemed panelists, and over to you, Mr. Abhijit.
Hello. Thanks, Ala. Thanks for the warm welcome. Hello, everybody. I'm very pleased to welcome you all in this webinar on selling solar assets in India, which is on unlocking the secondary market potential. A very good afternoon, good morning, and good evening to various market leaders, experts, and stakeholders who have joined us from India and other parts of the world. With profound happiness and privilege, I welcome our all esteemed panelists who are the market leaders and the experts in this sector to share their invaluable insights based on their experiences in navigating the market dynamics and the potentials for sell side transactions of solar assets. So in 2024, solar asset acquisition remained quite active. Around 217 large scale solar asset deals were done, which accounted to around capacity of 37.7 gigawatt. This holds around 20% of Asia's renewable assets M&A deal, with the major focus on solar and wind, and it is driven by the focus areas due to the cost advantages and high demand. As we go ahead, we see this sector and the further consolidation would grow, specifically in the small solar players, supported by government policies, the ESG obligations and investment focus. Private equity, project developers, and IPPs are the key acquirers, with investment firms and utilities also participating actively. We have also heard recent market deals in India where JSW Energy acquired 4.69 gigawatt from O2 Power, valued at around $1.47 billion. War Energies have also acquired NL Group for various solar and wind assets for 100% company's share capital. So with more further deliberation, I would step out to the discussions with our esteemed panelists covering various imperative topics and dynamics and consideration for solar asset sales in India. So the first key point, key discussion point, we would discuss on regulatory landscape and how it is evolving to support the secondary market and solar transaction. So my first question is to Ms. Kritika, like, could you please share your views on regulatory landscape evolving to support secondary market solar transactions?
Thanks, Abhijit, and thanks, Solar Quarter, for the opportunity to participate in this session and share my thoughts. To answer the and the other thing is the lock-in period. So the lock-in period earlier in the PPAs for the early shareholding transfer, which has now reduced to 1 year, and also on flexibility to allow the change of controlling shareholding even before the 1 year post COD lock-in period, which was there earlier. So we had to be the 100% subsidiary.
Uh, Kritika, I think we are not able to hear you properly.
Ms. Kritika, I think there is a network fluctuation. Uh,
Where the main bottleneck and
Miss Kritika, can I recommend you switch off your
also
camera and
because of active secondary essences and judgments may be taken account while taking any related decisions, taking any into account while taking investment decisions when we are indemnity or lies when we do sale transactions. And there has been a lot of awareness about various approvals and clearances, range of commercial and legal impacts which any of the commercial approvals and clearances can happen, like the white category, the State Pollution Control Board, GIB. So all those precedences help in taking a very informed decision while going through any sale transaction. So these are few of the things which has enabled the secondary solar sale market in India.
Thank you. Thank you, Ms. Kritika. No, we lost you in between. So, yeah, so we can come back to you again because of, I believe, the network issue or something with the maybe technical glitch. So, over to you, Ms. Swati. You can share your views, perspective, enablers on challenges with respect to the regulatory consideration. We can come back to, again, Ms. Kritika on the same thoughts.
Right. So when we are talking about solar, typically there are the utility scale or the discom projects, and there is also the CNI market, the commercial and industrial market. So to begin with, some of the recent regulatory changes that has facilitated this sector, and we have to talk about it. I think Kritika did touch upon it, but unfortunately, we couldn't hear her well. The first important sort of change that's occurred is through the introduction of the bidding guidelines, and the solar bidding guidelines have reduced the lock-in period, which is the period up until which 51 percentage of a project SPV or a portfolio holder is being locked in. That's been brought down to 1 year. Earlier it was 3 years under the bidding regulations, and in 23-24 it was brought down to 1 year, thereby showing that the government has realized the need of monetizing these assets, that there is a strong secondary market out there with investors looking to come in and invest into the secondary market, which has more stabilized pool of assets. And bringing down the lock-in period obviously attracts the investors, because you are still getting into a project at its initial stages, and not once it has kind of like rolled on for a considerable time period. Along with that, a couple of other things that we should look at as positive changes are the national monetization pipeline issued by Niti Aayog. So here, the central government has clearly acknowledged that these sector agencies, the central sector agencies such as NTPC, NLC, they need to divest some of these capacities held by them. So currently, I think when it comes to solar, it's more than 2 gigawatt of capacity that's sitting with an NTPC, NLC, and all of them put together. And it is acknowledged by the government and by these agencies that private sector play is required in in these sectors, especially solar, and government should only act as a steward, directing and kind of regulating the sector in the right direction. And the private players should come in and take over these capacities to make the sector more robust. They've brought in lots of parameters, measures. I mean, the amount of monetization, the percentage of assets that they're looking to privatize in the next few years in the mission pipeline. At the same time, they've also put in a realizable value to the solar asset, so which is around 5.5 crores per megawatt of solar asset, thereby helping the valuation of these assets to say that here is our projection to these assets, and from here we could start negotiation with the private players. So, which are all very forthcoming moves from the central government side, which was looking at things in a very close manner prior to the last 3 to 4 years. We should definitely acknowledge the accelerated depreciation incentive as tax reform available to solar sector, where about 40% accelerated tax depreciation can be claimed in the first couple of years after commercial operation of the project. So which means that you're looking at an asset with more of a cash flow, and due to that it also becomes more incentivizing for investors to come into these projects. So RPO targets are always going up. The other aspect is that the renewable purchase obligation is only going to go up. So states have been pushing discoms to include more of renewable power consumption in their net consumption portfolios, and this is only going to increase considering we have a net zero sort of target by the 2070s coming up. The RPO obligations of the discom is only going to increase, and that's going to one way or the other push the discoms to promote more of renewable development, and a key part to that is solar. Now coupled with the hybrid sort of scenario that's developing, the battery energy storage that's mandated by the government for all renewable projects, it shows that government is also focused on grid stability and having round the clock supply into the grid. So all of these read together are making the government's initiative to monetize, expand this market along with the secondary market. The vision seems to be strong, and there is a remarkable shift from what used to be the regulatory scene earlier and what we are seeing right now. And the hope is that this direction will continue and we'll see more reforms to help the secondary market.
Thank you, Miss Swati. So I'll go back to Miss Kritika and take 2 minutes. Like as Miss Swati stated, that the national monetization pipelines are the enabling policies. However, she was also picking up on the lock-in period, the equity lock-in period. So just share your thoughts and in next 2 minutes, like how they are coupled, in terms of one is enabling, but sometimes from the buyer perspective, the lock-in period becomes kind of a deal breaker, no breaker, something. So, Miss Kritika, if you can just share some your thoughts.
Thanks, Abhijit again. So I think my network is acting better now, I hope.
Yeah, it is, yeah.
Okay. So in continuation to what Swati just said, so lock-in period erstwhile in the legacy PPAs continue to be a problem because the legacy PPAs or the old PPAs, the new standardized PPAs which have allowed flexibility, the projects under those PPAs are yet to be constructed. So they are still at a PPA stage. But the transactions which are happening in the market today are all of 2017-18 era or vintage, in which those PPAs are very stringent. So there is a lot of lock-in period restrictions there. But as I was saying, the REIAs or the bidding agencies now are flexible. If there is a genuine case of sale, and they do look into it, and they do take calls on transferring of up to 49% of divestment. 51% still is under discussion, and the flexibility is still to be allowed for the 51%. But 49% divestment has become easier. And post COD plus 1 year, the divestment of even the remaining 51% of the controlling shareholding is also allowed.
Thanks, Ms. Kritika. So, moving ahead on the similar line, what you have seen and what are your views in terms of the key legal and your contractual challenges in terms of PPA transfers, like locking period we have already discussed, but the PPA transfer during the asset sale, like how do you foresee these linked with the regulatory access in the key contract, the key clauses, which sometimes becomes very impeding in terms of negotiation and discussions.
So, the NOC is still required from the end of taker or the discount. So even if there is an intermediary in between, whether it is SECI or NTPC or SGBN, so the NOC from discoms and the LTA regime. So there is an NOC requirement still from the end state discoms, in which there are delays still, and it causes delay in closure of transactions and smooth transition of buyer to seller, the asset getting transferred. So from the state's angle, the all the standardization which we were talking about has happened at the central stage, but the states still have variety of different ways to deal with renewable energy assets till date, and the uniformity across state is still to arrive. So the state NOCs are still time-consuming activities.
Thanks, Ms. Kritika. So, Ms. Swati, can you share your thoughts and views in terms of, because you are part of most of the negotiation, the clauses which comes as part of the SPAs, the SHAs, and all during the deal transfer and all. So, what are the key the clauses which are like key drivers, key again deal breaker, or to give a go green? So, please share your thoughts on that.
Right. So when we talk about secondary markets, if it's a M&A transaction where the shareholding in the project SPV is getting transferred, the challenges are limited because SPV continues as is. We don't require an assignment of a PPA where a new entity has to be recognized by the DISCOM. And a lot of the registrations, I mean, like they can continue with the same SPV. So then that's more straightforward a route into the secondary market. The challenges are slightly more in case of an asset transfer. A business transfer agreement is, basically the structure where we have to go into what Kritika just spoke about, where you need the consent of your ultimate off-taker, which is a discom. And these are all challenges particular to the utility scale projects. Again, when it comes to CNI projects, they are more commercial in nature, limited regulatory sort of challenges or interplays. So smoother, sort of transaction when it comes to business sale. But coming back to utility, then without the consent of your counterparty, which is a discom, you cannot bring in a new entity under the PPA, right? Because the PPA will have to be effectively assigned or novated only with the consent of your off-taker. So that is like what Kritika pointed out, a very challenging process, and in the sense that it is time consuming. So your project closing timelines or transaction closing timelines sometimes cannot be sort of written in stone for this reason, and it kind of takes more time than what is anticipated. Other than that, when you're talking about transferring your key registrations, so your connectivity approval is, very integral to the survival of your project. Again, you have to go back to a government utility, a government authority, in order to transfer the connectivity into the name of the new entity that will now own the project, right? Because you're talking about a business sale. So that is again a time consuming process. You will have to, have lots of back and forth with your authorities or the government utilities in order for these approvals to come through. There are other registrations which you will have to get transferred or freshly obtained in the name of the entity that's coming in. So the steps that you have to take in order to achieve your transaction sort of summation in case of a business transfer structure is much more than a straightforward merger or share control sort of a structure. There, your only challenge is to get your PPA consent if the lock-in still continues, and most likely the transfers, the share sale occurs after the lock-in period is expired. Most transactions today that we see in the market are structured in that form. So these are some of the day in day out challenges when it comes to, like, the business transfer models that we see, and all of these become critical condition precedents to the transaction, which results in the transaction timelines mostly getting a little delayed. Other than that, if there are ongoing sort of breaches, say there are major PPA non-compliances, there are regulatory charges for quite some time, such as a DSM that your project hasn't paid, then it comes to how, as an incoming investor, you would want to take on these liabilities, right? So these are historic, legendary liabilities of the entity who was the PPA counterparty. Now you are only taking on the asset, not the liabilities. So you'll have to see how best to structure these aspects in your transaction document, so that you need not assume those obligations once you come in. You can have contractual sort of, like, guidelines in order to carve out those obligations before you come in. So these are few challenges that we see when it comes to utility projects from a contractual perspective. CNI projects, like I said, are more straightforward. As long as you're not, transferring the project to the off-taker, which is a private party, to its competitor or any entity that it is not agreeable with, we don't typically see a lot of challenges in a BTA transaction involving CNI projects.
Thanks, Ms. Swati, for sharing your views. So, as we move to the next part, we would be, really happy to understand how the buyers and sellers approach the valuation and undertaking the financial due diligence of an asset. So, Mr. Arunak, could you please share your thoughts on key components and attributes which buyers and sellers should approach for valuation and undertaking effective financial due diligence?
So I think there are two parts to that question. One is valuation, and second is due diligence. So valuation, look, ultimately, a large chunk of that bit is determined by what your cost of capital is, right? And you would not typically like to go below that. And then obviously, if you're reasonably clued into the market, you're also aware of at what levels transactions are happening in the market for assets of that size. So you would not like to overpay. But beyond that, it also cost of capital is one thing, but also what assumptions go into your financial model, right? So what is your cost of financing? Can you get any benefits? Lower cost on O&M, can you maybe lower your insurance costs, etc. So these are the 3-4 things you can play with financing being the most having the most sort of bang for the buck. In terms of due diligence, as far as a buyer is concerned, I think it's very important for you to have a good understanding of what the techno-commercial risks are, right? You can deploy all the agencies in the world on technical diligence, financial diligence, etc. But until you know what the real risks are and what risks you can live with, you will keep on doing diligence for 2-3 months and never find the end of a deal, right? So while you should do proper diligence, but obviously you should also try to sort of separate the wheat from the chaff, like what is important and what is not important. So for example, things like connectivity, if it's an issue, that will be important. Something like if the land is not clear, that could be important or may not be important. Obviously, if, for example, if you're buying a solar asset, if the modules themselves uh, you know fail certain tests, then that's very important, that's very critical. So you'll have to take a call for that. As far as the seller is concerned, obviously the obvious goes that the seller wants to maximize value. But from a seller's standpoint, obviously you want 2 or 3 things. You want a relatively short process. You have to figure out whether you reach out to a large buyer of a large universe of buyers, or talk selectively to 1 or 2 people, or maybe even 1 people. Because ultimately, I personally feel, alongside obviously maximizing your valuation, what is most important to you as a seller should be deal certainty, right? You shouldn't have a situation where you've done this for 4-5 months and you have, I mean, market conditions aside, you have nothing to show for it at the end of 4-5 months. So I would think timeline as well as deal certainty is, and of course, valuation is very important from a seller's perspective.
Thank you, Mr. Arune, for sharing your thoughts. So, picking up on the time and the deal which is going to happen, having from the seller perspective, it is very important that it should happen. The certainty. So, Mr. Atul, can you share your views on this aspect, the certainty, and how you approach for the valuation, and do the undertake the financial due diligence, the time period, the certainty, the relationship, the key aspects and considerations.
Right. Thank you, Abhijit. So for valuation, we should keep two things on the most priority, which includes one is the revenue projection, that how our asset, what we are looking for, have performed in past, what is the module degradation, what have happened in actual. The data sheet may differ, but actualization may be different. So we must have be going for some specialized test by the help of sub laboratories that can define the valuation of that project most. And then the risk assessment, which includes the inefficiencies, operational inefficiencies, which include the availabilities of the plant, or maybe some environmental factors. Just we face some issues in Rajasthan also, as an example, that the great bustard bird was there. So those kinds of operational challenges may be there in the future. That impacts the valuation much. And regarding the financial due diligence, definitely apart from all the things which Aruna have so told, tax and incentives are also a key part, and means we need to analyze, or a buyer need to analyze those tax benefits, what have been indicated, and the depreciation schedules, which includes incentives and which are tied to the assets, right? And definitely the last one, the debt and equity structure needs to be analyzed, because the refinancing is obviously preferred by any buyer. So that needs to be analyzed and for a better solution.
Thank you, Mr. Atul. It was really nice to understand, like from the perspective of financial due diligence pertaining to how the debt has been, have been the financial governance and all, how they have been structured, and it is very important for any financial due diligence. And again, a very nice point in terms of the ESG aspect, the socio and the environmental aspect, the how the valuation is being done. Mr. Arne, can you just take a couple of minutes, also share your views from the perspective of ESG, the environmental aspect, how it leads to the valuation? Do you have any experience or thoughts on that?
So I think obviously every buyer, or this is more from a buyer's perspective, I guess, but every buyer has a different view on ESG. They're driven by their own internal guidelines, what their investors, what their shareholders are saying in terms of their ESG requirements. But for many people, obviously, ESG, ENS is top of mind when it comes to acquiring an asset. I think Atul mentioned the whole GIB issue. So different people have different levels of tolerance for buying assets in that area. Some people can go the whole hog and buy anything, whereas some people would stay away even from the potential zone, right? So it's a whole gamut of requirements. Similarly, other people have certain requirements with respect to wind turbines, right? What happens next to wind turbines. For example, other things could be how a community is taken care of, in the areas where the projects are there. Similarly, and so now the other important thing is obviously nowadays is supply chain. Where are you, sourcing your cells from? Do they have linkage to a, certain region in China, etc., etc. So particularly for some pension fund, sovereign wealth fund type investors. So they play an important role in any considered deal, not necessarily in terms of value, but more in terms of what people can do or cannot do.
Thank you, Mr. Arne. So moving ahead on the next component. Mr. Karim, like Oyson aims to, aims to support project developers by sourcing partners, equity, financing, or buyers, and investors by sourcing projects. So, can you please share your experience, your thoughts, your insights pertaining to common risks in secondary market transaction, and how they can be mitigated?
Sure. Thank you very much. Yeah, indeed. So Horizon Invest is, a boutique where we work together with investors and project developers and trying to, help them in, reaching financial close in the transaction. So we're active globally. So we closed the 600 megawatt plus in 8 different countries. But India is a big market for us. Recently, we closed a 135 megawatt and another one in 35 megawatts in UP and Karnataka. So we have but we failed also in some of our negotiations. So how do we work? First of all, what we see that there are some discrepancies, and I think Anune mentioned that regarding the yield, regarding some assumptions, etc. The buyer and the seller may not have actually the same view. So while you could at the very beginning agree on a price because you want to actually stage the negotiation process, because the more you go further, the more cost, because then you will have to appoint during the due diligence legal advisors, technical advisors, and so on. So what you want to do is to have a first agreement between the buyer and the seller, which is reflected into a non-binding offer. So at this stage, both parties, they want to do the transaction, and maybe the buyer actually is okay to have preliminary assumptions which he believes that are a bit aggressive, but that could be managed somehow in the due diligence. And therefore, the price in the NBO is usually higher than the real price that you will get at financial close. And for me, the question is to understand how far you are from the valuation that will go at financial close compared to what you have at NBO. And that is regarding, so you have different assumptions. For example, the way you're going to distribute dividends, the way you're going to assess the yield. And I will give you one example, which is more important in the wind, but it's also important in the solar. As you know, with climate change, actually, the weather patterns is changing. And therefore, you may see in some areas, some trends, and some investors are trying to ask that to factor it. It's very complicated, etc. But you do have some technical advisors that are taking that into account. And so, you may find also the way you are cleaning the panels, so with robots or not, and how you may improve the maintenance during the operating process. So all that, and also the pyranometers, also, how clean they are, how you're going to maintain them, if you change them during the operating period, etc. So all that, leads to, you can have huge discrepancy actually in the yield assessment. And so I would say that is important to understand, how far you are and what are the assumptions. And I would say that I would recommend actually to have some, don't hesitate actually to share more information from day one actually in the transaction before even signing the NBO, because then there's no point, if you know that there are some assumptions that are, too far from, or not too far because you already believe that actually, but the investors may not, take that into account. And so I think this discussion may have to happen from the very beginning, because what you really don't want is to have a big gap actually between the price of the NBO and the financial close. So that's what we do actually. We're trying to, kind of bridge, this information asymmetry in the transaction, and to make sure that, when the process is on, then people, know where they are going, and you will find some discrepancy, no problem. But, then it should be manageable during the process.
Thanks, Mr. Karim. So we understand it is very important and imperative the trust building between the parties when they get into a kind of agreement between sharing the information from the day one. It's not about the valuation, the regulatory dynamics, or the technical aspect of the financial, but also between the parties of building the trust. So this has become very crucial. That's really nice and helpful, Mr. Karim, that you have brought this point. Mr. Kapil, can you share your experiences also developing on the point which we were alluding right now, Mr. Karim were alluding right now, on the common risk in terms of the secondary market transactions?
Yeah, I think I may have little bit a different opinion because we already acquired around 800 megawatt from the market, secondary market recently. And my experience is that whenever you acquire probably multiple time, we are not able to find it a right value creation strategies. And when you are on the ground and in a position to make a difference, in a position to create operational excellence, you find lot of opportunities. I mean, let's see. I mean, start with the repowering, start with the new kind of nano coatings are coming up, making sure the soiling losses are drastically reduced by putting the robotic cleanings. These all things are pretty mature. If you ask me 10 years before, probably it wasn't there. But today, if any asset is there, literally you could fully retrofit it and find a way. You'll always find a financial reason uh, to to get things improving. So I don't think there is a very limited concern in terms of technology or the operational risk point of view. It's more about that how you are managing the assets. I agree there are sometimes there are regulatory risk. Let's say change in the DSM recently where the bands are reduced. Probably industry is not ready to. I would say the forecasting agencies are not fully ready to operate in the band of plus minus 5%, where over injection is not going to allow, and you need to come up with a strategy for under injection. Those are the risk. But the way things are changing, the way the AI coming in the picture, I'm hoping that right models will be in place, aggregation will come in the market, and then also the integration of the battery storage. So all these things are going to support to mitigate those days. So I think today I'm very confident. I'm being in the industry from last 18 to 19 years in India, and I realize that very limited technological risk, at least on a solar side. There are some resource risk, which Karim rightly mentioned, that if you look into last couple of years, the radiation has been a bit on a lower side. But whenever you do a due diligence or when you buy a asset for a secondary market, you don't only look into 2 to 3 years of the data. You look into last 20 years long term average, and then you build your models. So maybe for a short term year, there are climate risks, but when once you average out from last 20 years, probably technically you will find the variation is what plus minus 1 or 2%. So very limited risk on that side. You have those market risks, but I don't think most of the Indian PPAs are governed with the philosophy to have a long term 25 years PPAs. Discoms are pretty much okay today. If you look into Indian discom, there was a time, like let's say 5 or 6 years before, where Ministry of Power was not supporting, then payment used to get delayed. Today, with the Prapti portal coming in, you get payment done very fast. Look into some good discoms like Punjab, GVNL, where the payments are happening within 5 to 10 days. Wherever there were issues, the central government has come in, and today all the payments are coming within 60 days, which is very normal from that point of view. So those risks are mitigated. Somehow with the renewable industry, the cost of capital has been reducing. I mean, it's getting benefited from that, compared to whenever you acquire the asset, you find it out that maybe during the construction time your cost of capital was high because there's a construction risk involved. The moment you buy a operational asset, you are always able to reduce the cost of capital, and that's another value creation strategy which comes in. So at least my experience has been that whichever asset we are buying, we are able to create a lot of value. So that's a
So
limited thought from my side.
if I may comment, maybe
Yes,
you don't
Mr.
mind.
Karim, please.
Yeah.
Yeah.
So yeah, there are two elements here. Number
Yeah,
one is the risk assessment, and the number two is the valuation.
correct.
So regarding the risk acceptance, I absolutely share your view, actually, Kapil, and And actually, this is exactly my message to the investors who are, looking at the Indian market, because they may think that there are different risks, and there are some risks during the development stage. For
Yes.
example, litigation on the land, etc. That's an issue, right? So during the development stage, there are some risk, yes. But then after that, in the secondary, well, you are in the secondary market is different. And
Yeah.
honestly, when you look at what happened during the COVID and how the disco actually, how the state actually managed that, and then the disco how they manage it, it's well managed at the end of the day. It is not, it was not disrupted for very much long time, and then disco went back on track, and the payments are on track, and
Yeah.
actually, so I feel that it was well managed actually this period of time, and there was two strong elements. One is the Supreme Court. They one disco a few years ago tried to renegotiate somehow PPA, and it was not accepted at all. So it's the
Yeah.
PPA are very strong. And the second point is during also the COVID, then there was also a new regulatory framework which says that the disco they would not allow to be trading electricity if they have too much on the outstanding amount. And so these are very strong messages from India, which says that no, we have a very safe environment, safe contractual
Yeah.
environment. The PP are strong, and so for me, the risk actually are not huge. And in terms of operating assets, and obviously we're talking about solar, right? So it's cleaning
Yeah.
and things like that.
Yeah.
So
Yeah. Correct.
the risks are very limited. That being said,
Fully agree.
in terms of valuation, as everyone now, the cost of capital, because it's a more mature and safe environment. Indeed, you're trying to negotiate SECI or NTPC assets at a 10% return in dollar, when you convert in dollar, and maybe 11% or whatever when you are with the disco PPA. And so now you're talking about the small percentage, right? And you're trying to optimize that. And so, in this case, there's a difference when you assess your yield at, 1,780 or 680, and then 1,735, then you may have, some differences in terms of core in your valuation. And that's where you have this, differences. So, for example, if I take climate change, so I'm not saying that it's a major issue today. It is for the wind. Let's be clear. For the wind, there are some issues. For the solar, if you look at in some areas, you have a sandstorm. A sandstorm, it can disturb actually a lot your production. So over time, in the 25 years, how you're going to assess that in the yield. So there are some, discussion like that. I'm not saying that there's not going to be a red flag for the transaction. I'm just saying that will impact somehow the prices, how you will assess actually the value of the asset. So if the gap is too wide, then the parties may actually not find an agreement at the end of the day. And so that's where you need to try to bridge this gap by trying to find the middle, somehow, middle stage where you say, okay, I take this, I take that. And there are different parameters actually in the negotiation which you can play so that, the parties can meet together. So that's what I was, mentioning.
Yeah, I
Thank
think
you. Thank you.
just
Yeah,
to
Mr.
just a bit comment on that, or maybe add, Karim, look into the renewable industry, at least from a solar point of view, talking about sandstorm. I mean, maybe more than 40% of the India's solar capacity is in the area where the sandstorms are very, very frequent. And those are in operation, what, like more than a decade? I mean, you are talking about a gigawatt of assets getting built up in Saudi Arabia, Middle East, where sandstorm is very common. And these, so my what I'm saying that the technology has evolved a lot, and today the level of technology which is there, the mitigation measures are in place. My assets, at least within the Blue Pine, which is 100% funded by Actis, and we are investing $800 million of the capital closer to developing 4 gigawatt assets. I would say that out of 4 gigawatt, maybe around 1 gigawatt would come in an area where the dust storms are common.
Yes, yes.
Then you got a technology for a robots, correct? Robots are very, very well developed. We do a daily cleaning. If the sandstorm comes within a night, all the dust is out of the panel. So it's more about that people. How do we see that? So it's not that only the construction philosophy change or design philosophy change. There are a lot of changes are in our operational philosophy where value is getting created.
No, no, I fully agree, Kapil. Actually, I think the no, no. So I fully agree, and I think the difference is that we are a smaller player than you actually, and our
Yeah.
investors they buy. So my mandate is to buy assets between 50, 100 megawatt up to 200
Yeah.
megawatt, 250 megawatt, and therefore it's difficult for me to play. For example, with the regions or etc. That being said, my investors, they have already 300 megawatt and they want to buy 100, 150, 200 per year. So at a point in time, they may have, this way of managing their asset. I agree with you. But when you buy a single asset, then you may be a little bit more prudent, I
Yeah,
would say,
yeah, but
or
the capex
there's
are
you have,
very small to manage all these kind of
yeah, you have
issues
limited,
related
you
to
see,
planning.
options,
Because
but you do
once
have
you're talking
options.
about, yeah,
What I'm saying is
talking about
that
you
there's
talk
no
about very
red
small
flag,
capex.
right? It's about
Yeah,
optimization of the negotiation. So,
correct.
and maybe you also, I don't know, are you more buying asset or are you more selling assets?
I think we are. So as you said that our commitment is to have a full investment of $800 million, and we did acquire closer to 900 megawatt of assets as of now. There's a greenfield development which is anyway is ongoing of closer to one and a half gigawatt plus. So intent is to raise 4 gigawatt. I'm pretty much sure that my investment team keep looking into the assets, whether it's for M&A or greenfield or shovel-ready projects. It all because you still have that capital as equity is still available.
Excellent.
So we are always looking for the right assets to buy.
Excellent.
Thanks, Mr. Karim and Mr. Kapil. So yes, we understand like the evolving technologies, the battery energy storage solution is gripping the market in terms of to evade the DSM effect, the challenges which are one of the risk which the developers and IPPs they look into. Also, the financial strengths of the discoms, which Mr. Kapil said, that the receivable periods has now become controlled, mostly getting to 60 days, and also that also kind of eradicates the most of the main risk which how the investors look into. Just Mr. Atul, you can take a couple of minutes to discuss also other risk before we move to the last phase of our discussion.
Right. So I'll definitely back what Kapil have told. So it's maximum the operational risks were there earlier. Those were the earlier days where people used to get scary about those things, right? So operational risk maybe including the lower plant availability, lower grid availability, or maybe the degradation pattern of the solar modules, or maybe something like that, right? But yes, nowadays we can see that the grid is so strengthened that we are having the 100% grid availability at all times. In case of the plant availability, so we always can have the service level agreement with the inverter supplier, where the almost 99.5% availability can be ensured by the OEM itself from the inverter side. So risks are there, but yes, a proper mitigation plan before within the due diligence domain or the due diligence time can be prepared, and that can be costed, and that cost is not too much. If it is costed and budgeted properly, then those risks are just minimal risk, which just it's a need of the people who are dealing with that. They can very easily mitigate and can hand it off.
Thank you, Mr. Tu. So, moving to the last discussion point, and thanks, Mr. Kapil, for your invaluable times and insight sharing with us. Moving to the last phase of our discussion point. So, Mr. Arunay, I would really appreciate if you could share your viewpoints coming from your experience on what drives IPPs and developers to, exit solar asset. How do they though we were discussing on identification of the right buyer in terms of trust and transparency, could you please share your views on this?
I think your question was what drives IPPs to sell assets, and
Yeah, usually the IPPs and developers, what are the key drivers which they look into when they think about maximizing value from selling the assets? So what can you share all those points?
look, it's a pretty common phenomenon, perhaps less common in India, but more common certainly globally. That all developers and IPPs, their main job is to develop assets, right? To make greenfield assets, and there is a certain risk associated with that. And once you've developed those assets, hopefully you get a kicker, once the asset is operational and stabilized, um, and then you sell those assets. So some people, some people, private equity backed platforms, do that over the course of 3-4 years. They develop a full platform, and then sell the whole platform. Or let's say someone like us, we sell certain percentage of our assets that we develop every year, right? The idea being obviously to realize the premium, because if you're setting up assets at a certain cost, right, at a certain IRR, but once it's operational and stabilized, you can sell it at a much lower IRR, so you can obviously make the spread and the margin, right? And you can redeploy that into future projects. And the reason why you would do that is because obviously if you're looking to develop a lot of assets, you may not have all the capital available to do it. Let's say you may have the capital to develop maybe 2 gigawatts every year, but you see market opportunities to develop 3 gigawatts every year. So obviously the differential will be made either through equity issuance or through capital recycling. So that's what drives a lot of IPPs or developers to keep selling some assets to realize that premium and redeploy that into newer opportunities.
Thank you, Mr. Anne. So, moving on that aspect, like the key drivers for developers and IPPs for exit. Mr. Karim, can you share because the deal has to get closed with a successful closure and negotiated terms. So, what do you think in your view? What role do intermediaries play enabling deal flow and ensuring successful closure?
Yes, so well, first of all, I take this opportunity to say hello to Anune and Treliger also. We did some transactions together, and it was successful transactions. So it was a very good experience. So I can share that. Look, I mean, developers they have different goals, right? So either they are small or big. Their intent is different. Large, some people they just sell assets to recycle actually their portfolio and get cash and reinvest. Some others they are they have only limited portfolio of projects and they just want it all and just exit, right? So you need to understand that and this dynamic. Now, in terms of advisor or intermediary or whatever you call it, in my case, I have a mandate with an investor, so I kind of represent the buyer. However, I work with both the developers and the investors to make sure that trying to bridge this their expectations in terms of valuation, etc. So I think that you need to understand how people they work and what are their objectives and what kind of assumptions and how aggressive they are in different ways. You need to understand both the investors and the developers to be able to reach a successful transaction. If you don't understand both parties, then people they will just try to focus on their own expectation and then they will never bridge in the middle. So that's why usually I like to talk to both parties and try to even go deeper actually in the both financial models, financial model of the seller, financial model of the buyer, and try to reconcile actually the models and try to see which assumptions where there are some discrepancies and how we can bridge them. So in a way we are both the best friends and the best enemies of both parties, right? Because we're trying to increase the price of the buyer as much as we can. But at the same time, we're trying also to optimize his returns. So in a way, it's a how do you do that? Well, there are many ways, and actually, many of my colleagues or friends they mentioned that. How do you counter accelerated depreciation? How would you distribute dividends? It's all about this small percentage here and here that you can gain, and when you can convince actually the investor. I mean, myself, I'm trying to optimize the price and trying to get it up so that the transaction can close and the seller is happy. So there are, many different percentage and risk appreciation, etc., that you can play with. And at the end of the day, if your investor understand what is the Indian market, what are the returns expected, and what is the average, valuation, then you should meet, you should close your deal, because at the end of the day, as many mentioned here, it's quite mature market actually, and so there's kind of process, standardized, etc. So as long as you have a common understanding from the very beginning of the key principle, etc., then I feel your transaction should go well.
Thank you, Mr. Karim. Thank you for sharing this valuable insight. So, as we are coming to the end of this session, now we would open for Q&A session. I can see a few questions have already popped in, and I request other participants also to share their queries, concern, questions in Q&A. So, first, there's a the process of selling a standalone solar asset vis-a-vis a platform. I request any panelists to take that question if anyone interested.
Maybe I can start. Look, the key difference is yeah. So the key difference is basically one single asset is exactly that. It comes with one PPA, one set of O&M costs. All of that. You have to basically estimate the generation, the PLF, and then figure out the value, right? So it's a lot simpler. A platform obviously is not just a pool of assets, but beyond that, there'll be some assets which are operational. There'll be some assets which are in the pipeline, which you will have to develop yourselves in many cases, which will be greenfield projects. And plus, it also comes with its own set of capabilities, right? So that's typically in the form of people who may be looking to do, who may have capabilities in O&M, EPC, land acquisition, project finance, etc., etc. So it's and the expectation always is with respect to a platform that all those things beyond just the value of the asset has to be valued, right? So it's a lot more complex to do a platform acquisition. Obviously, those are also typically much bigger, involve bigger check sizes than just doing an asset level acquisition.
Right. I'll just add to what Mr. Anunay just said. I mean, even from a contracting perspective, like when you're dealing with your share transfer documentation, your SPAs and all that, one asset will have probably 3 or 4 asset related issues that you will need to resolve before your acquisition concludes. When you're talking about a platform with say 10 plus almost 20 assets, that's tripled into or rather multiplied into so many times, right? I mean, you will have to resolve issues as at an asset level. You will have multiple conditions to the transaction closing that you will look at your counterparty to close. The level of issues with respect to bookkeeping will be multifold. With such a large portfolio, what I have also seen as an operational issue on the ground is that it gets tougher for the portfolio managers to keep all the documents together, to have like a good record, to have all approvals, key approvals in place. Sometimes copies go missing, then you have to hunt around. I mean, there are a lot of nuanced smaller issues which add up and kind of make it a very elaborate and typically complicated closing is what we've seen. Again, when you're talking about your indemnities, your set-offs, I mean, it's a single asset versus portfolio which has multiple assets. So of course your negotiations are protracted, long drawn. So net it is volume cost by size. And when it kind of transpires into documentation, it gets all the more difficult for parties to come to a landing and close negotiations and actually proceed to closing. So the challenges are just 1 versus 20. It's literally that.
So if I may add to what Swati and Anune said, the one more factor in a platform and a standalone solar asset sale is the employees and the processes which come along with the platform. So all platforms have a DNA of the investor. So when the platform sale happens, there is also the DNA transfer from one investor to another investor. Versus in a standalone solar asset, it is just the asset which the another platform is acquiring, and also there are employees.
Thank you, Ms. Kritika. So we
Maybe
move.
just one small
Yes,
comment is
yes, yes, yes.
these are different investors actually. In many cases, some investors they actually only invest in platform, and other investors they want to buy assets, here and there. For example, my investor they just want to buy assets and they don't want to invest in platform. So if I'm a seller and I have to decide one or the other, then I need to understand actually which, the profile of the investors I'm dealing with. And so if I sell a single asset, then I need to make sure that the investor in front of me understand actually, the kind of market he's dealing with and the returns he should expect. Because they may think, okay, I will buy a single asset, so it will be more costly, so the returns, etc. So maybe if you compare with some valuation on the portfolio level, then you say, oh, but then the valuation is lower than what I can get. So if compared to the gigawatt deal, etc. So there's also some kind of understanding process to conduct to make sure that you have the right expectations on both sides. Both the investors should make some efforts, and sellers to understand that also.
Thank you, Mr. Karim. So we are coming to the end of the timeline. I would take two more questions. So Mr. Satyaki, he asked, like, what is the market standard for dealing with purchase prices? Is logbox mechanism widely used or closing account basis? So yeah, anyone can take this question to answer.
I can comment if so. Just to start,
Yes, Mr.
we
Karim.
did both. So we did both. We used in our transaction, we use both logbox and closing accounts. To be honest, I don't see a big difference. At a point in time, if you do closing accounts and the CPs, take time, then for sure the parties they will they will come back and say, hey, I've been signed my SP. I signed my SPA 6 months ago. So, and the valuation was X. So no, it's too much. It's too long. So then the parties will renegotiate price. So we went through this process. And it's fine. Both parties they understand that. They understand that, okay, it took time. So it's fine. So let's find an agreement. Logbox, it's clear. You did the logbox, then there is percentage, etc. But even that, you may, ultimately, if you don't close quickly, then parties don't like that. Both of them. So make sure that in the CPs, you have you have this understanding of, for example, if there is kind of land litigation or land conversion, for example, to NA. So there's no litigation, but you need to convert to NA, and you are in this process, but there are some delays, etc. Make sure you have a good understanding of how many months actually there, and so be prepared to some kind of negotiation if the period is too long to meet with the CPs. That's my only point, I think.
Thank you, Mr. Karim. So the last question was again by Mr. Satyaki, and I'll just elaborate the question. So he asked, like, how much secondary sale is happening to large asset managers, pension funds, basically the folks in with patient capital. Most often we are seeing acquisition by development capital, that is new P backed platform who have quotas to fulfill. So any panelist member, if anyone would like to take this question, answer to understand how this is working, the market dynamics.
Right. So pension funds are pretty active in this market. We are seeing a lot of secondary sale to pension funds and also to few asset managers. But though the large asset managers in the recent past, I've seen a couple of them offloading their portfolios, not acquiring. But yeah, they've been active in the market and they've done transactions in the past. But pension funds are also active. We do have like pension funds, uh, you know, uh, in the market who are pretty active. So yeah.
Thank you, Ms. Swati. So, with this, we come to the end of this webinar session, and thank you, esteemed panelist members, for joining us and sharing invaluable insights. I'm sure the participants has made most from this in terms of understanding the guides. It does not provide entire guideline, but the key curves, the key regulatory market dynamics, the key technical financial aspects to be considered, the ESG aspects to be considered during selling of solar asset. Trust building, which Mr. Karim said, because it saves time for both the parties. So thank you everyone for joining us today for this session, and it has been a really pleasure and profound happiness. I thank you all again. Ala, over to you for the ending remarks.
Thank you so much, Mr. Abhijit, for leading such a thoughtful and enriching discussion. And a big thanks to all our esteemed panelists for generously sharing your expertise and experiences. Before we close, I would just like to run a few more poll questions that would make us get to know our audience a bit better. So, again, these are open. So, I would request the audience to keep filling in their votes for this. And I would also like to mention that it has indeed been a very thought provoking session, and our audience will be taking back a lot from the discussion. So, thank you once again to our esteemed panelists and, of course, to Mr. Abhijit Kumar for facilitating such an effective session.
Thank you, Ala.
And,
Thank you, everyone.
thank you, and special appreciation to our audience members as well. We hope today's conversation has sparked new ideas, connections, and opportunities for your business journey. We'll be back soon with more impactful sessions focused on the clean energy transition. Thank you once again and a wonderful evening ahead. The floor is now open for networking. Thank you all.
Thank you.
Thank you, Mr. Karim. Thank you, Ms. Kritika. Thank
Thank you,
you,
everyone.
everyone. We'll stay in
Great
touch.
chatting
Thank
with you.
you.
Thank you. Thank you,
Bye.
everyone.
Have a good evening.
Yeah.
Bye.